Well, good afternoon, ladies and gentlemen. After such a positive intervention by Jack, I think I owe you a very detailed explanation of the Capital Markets Union and what we've actually done, because I've just learned that no one knows what it is. So I think we do know, and we did know when we started with the project about 4 years ago, under not so new commission any longer, what we wanted to achieve. So where we wanted to end up. And we wanted it to end up with something which would be much more mature, much more liquid, and much more integrated. We wanted to end up with markets which would be available, accessible to companies that would wish to seek financing. They would be available to investors who would want to diversify their investments and invest in all kinds of assets. And the markets that would provide with the right infrastructure to connect the so-called supply and demand. So this was the intention about 4 years ago. Since then, the Commission put forward about 70 different legislative and non-legislative measures. So we've been pretty active. So now we are approaching the end of this Commission's mandate, so probably the best time for us to take stock of what we've achieved, or perhaps where we would need to work a bit more to achieve more under the next Commission. So when we started on this project, we saw it as a project which basically has to tackle a lot of structural issues, but also the issues that would be related to socio-psychological problems. Why socio-psychological? Because some of these issues, some of the problems underpinning lack of investment, notably by retail investment, have to do with the understanding or perhaps perception of capital markets, that capital markets are too risky to invest. And these issues are notoriously difficult to deal with. So during this mandate, we largely focused on what is structural, so structural problems. The approach that we've taken was when the issues were known and the EU had competence to act. And I would like to draw your attention to the fact that we don't always have competence to act. We would like to act, but not always are able to, or not the way we would like to because of the treaty limitations. So where we had competence, we usually opted for a legislative mend. So we proposed a legislative change. This was the case, for example, with the prospectus rules, one of the first regulations that we put on the table under the CMU project, where we acknowledge that there is a lot of red tape and the IPO costs are rather important for notably small and medium businesses. And when we tried to cut this red tape and came forward with something which got the name of growth prospectus, so for an alleviated form of prospectus for smaller companies or smaller issuances. When the issues, on the other hand, were less known, we consulted the public, we did studies, and this was the approach that we adopted in the case of corporate bonds, for example, because we realized at one point in time that we have an issue with corporate bond market, the market that is not liquid enough. And we looked at the underpinning reasons for the lack of liquidity. As a result, we came forward, or the consultant came forward with a number of recommendations, some of which we have already acted upon. Now, in the case where we knew the issues, but we didn't have the treaty base, or didn't have the competence to act, like in some very difficult issues related to tax, we opted for close engagement with the member states. And we came forward with something which would be a workable instrument given the limitations imposed on us by the treaty, so code of conduct on withholding tax. So withholding tax, as you know, is considered to be one of the important problems for cross-border investment where the tax treatment does not allow for quick recovery of tax that is being withheld at the point of origin. Now, what can we say now? Can we assess the impact of everything that we've done? Probably not yet. Why? Because most of the legislation that we've put on the table is not in application yet, not in force. And to be honest, nearly half of the measures that we've proposed is still in discussion across the street. We hope to complete most of the proposals that we've put on the table, but we're realistic. We won't be able to complete everything before the elections, before the standstill of this parliament. So we do need the support of the member states and the support of the new parliament to continue the reforms that have already been tabled. So where are we today? I think we start noticing positive development in the market. It would be too early to say that these developments are because of all the reforms that we've put on the table, but these are positive signs and signs that hopefully in the future would give rise to more structural changes in the market and behavior of market participants. So we see that the level of there's more listed equity. So if you look at the levels of listed equity expressed in terms of EU GDP on balance sheets of non-financial companies, if you compare it back to 2014, we basically have an increase to 44% from 36%. Not a huge increase, but an increase nonetheless. A small increase also in debt, in listed debt, so from 8% to about 10%, I think, of EU GDP. So you would say a small increase, but nonetheless important, because I hope it's an indication of a trend which seems to suggest that non-financial companies are increasingly tapping the market. So when we started the project, the idea was not to replace bank lending, because it's not needed and it's not right. Some companies need to have access to bank loans. The idea was not to replace, the idea was to complement. So what we're seeing today is that complementation is gradually taking effect. So we see companies increasingly tapping capital markets through getting listed equity, listed bonds, but also unlisted equity and unlisted bonds. We also see some positive trends in terms of retail investment, even though I'm not going to pretend here that we've solved the issue and there is, retail investment is booming. As I said, retail investment has to do more with socio-psychological barriers than with structural, even though structural probably as present. And it would take time to change the mentality of people and perception of capital markets. But we do see that cross-border distribution of funds goes up, which is always a good thing, because we're talking about also market integration and cross-border reach. So all in all, I think we have elements that would set the fertile ground for the future Commission to continue acting on this EMU project. Because as much as we would like to, we're not there yet. I think the Commission has delivered on what we've promised to begin with. We've put on the table a set of measures, legislative and non-legislative, to set the foundation. We've never said we would complete this EMU because it's a long-term project, and we've always said it's a long-term project because it requires the change of perceptions. But I think gradually we're starting to put in place the right conditions, the right legislative framework to enable the gradual change in the market that would lead to better integration, better maturity, deeper liquidity of markets. So with this, I think I will conclude. So the next Commission will start its work in a few months. So in November we will have a new Commissioner. New actions, new priorities will depend on the new Commissioner and the level of ambition. But I think I can be quite frank with you that capital markets and the Capital Markets Union project, as it is, would remain to be a high priority for the next Commission. And I think we need to do more. We need to go further, and we need more support of the member states. Because some actions, as I said at the beginning of my presentations, go into the foundations of national legal orders and require very strong support from the member states and market participants alike. Without this support, we won't be able to deliver on the Capital Markets Union soon or ever. Thank you very much.